They need to isolate themselves from the underlying stock price changing. They have to isolate themselves from that risk. These volumes just continue to grow. And again, this is why we think the impact of the options market is so important on underlying stocks. As soon as that implied volatility drops, all these deltas are changing. And that invokes these hedging flows that have to kick in. Implied volatility can get so high that traders are pricing in, 50% daily moves in the stock, which is just not sustainable, right? So you hit these events where the implied volatility gets so rich and so high and so elevated that it almost starts to suffocate the move. You get these massive turning points oftentimes, and typically they come when there's a quarterly expiration. So what happens now is people used to say, well, the reaction to the news is more important than the news itself. And what happens now is you get such extreme reactions, I argue, driven by these derivative flows that people go, oh my gosh, DeepSeek must be the most important thing that's ever happened.
So Brent, today you get to teach me option dealer flows like I'm 5.
Yeah, and we cover this a lot, and so if I can't teach you after we've covered about 100 times, then I'm a loser.
Well, you would probably argue you always teach me like I'm 5 when we do the OPEX events every week or every month. I probably have about that level of knowledge.
Yeah, so I'm flattered by the idea that I can offer you any knowledge of value. So happy to be here, and we're going to talk about dealer hedging flows and just kind of what the whole idea of Gamma, Charm, and Vanna, what those concepts are and why they matter to you, whether you trade options or not.
Yeah, this is for all kinds of investors. We're seeing this influence markets more and more. We see these things that happen behind the scenes. People who are long-term investors like me don't necessarily know why they're happening. And a lot of times it is stuff like this that's causing these movements in the market. So even if you're not an options trader, even if you're not going to put on, your latest color or whatever, you can learn a lot from understanding what's going on behind the scenes.
Yeah, that's right. And as we'll show, options volumes continue to grow. And so I think the derivative, impact continues to increase. And so, these flows should be more important, I think, as time goes on.
And I think a good place to start with this is always, we have this idea that when I buy Apple stock, there's someone on the other side of that trade. When I buy a call option on Apple, there's a different someone on the other side of that trade. And who that is has a big impact on what's going on here. So can you talk about that a little bit?
Yeah, 90% of trades in the options market are facilitated by a market maker, and there's only a couple market makers out there, at least large ones in the U.S. So the liquidity provider, or at least who could be providing that liquidity to, is I think a lot more concentrated in options land than it is in stock. In stock, there's a whole bunch of different participants, and the banks can be larger, entities, and you got a lot more retail flow and stuff like that. And in the options market, you're generally going to have a group like a Citadel or a Susquehanna or a Jane Street on the other side of the trade that you're doing. And so that flow concentration can offer, I think, some more insights on how options trading impacts stocks.
And they don't want to have a position, right? And I think that's the key here is those places that are on the other side, they don't have a view on Apple one way or the other. They just don't want to have any risk.
Generally speaking, I think that's right. Yeah, they need to be out there hedging their risk, and there's a couple of different kinds of risk, but specifically the risk to the underlying stock, right? Because they're required to offer liquidity in the underlying. That's their mandate as a market maker. And so they have to offer bids and offers. They have to put bids and offers out there for the options. And, if you want to trade GameStop, they're there. If you want to trade Tesla or S&P or whatever it is, right, they have to offer that liquidity. And then, they need to isolate themselves from the underlying stock price changing. They have to isolate themselves from that risk. And they do that with what's called delta hedging. So we're going to get into that at the top of this presentation.
Yeah, and that's what we're going to get into here is how all these flows impact the market when they have to do what they have to do there, what it means for all of us as investors, those flows that are behind it. But a good place to go first is probably the growth of options, because I think all of us know post 2000 or 2020, there's been an enormous amount of growth of options. Way more people are using them. And I would assume that if there's flows generated by this, if more people are using options, those flows are just getting bigger.
Yeah, so this chart here is from the NYSE, and this is the consolidated option versus consolidated stock volume. And as you can see, from 2020 to now, we're up about 150% in options volume, where at the same time, we're only up about 30% in stock volume. And I would make the argument that some of that stock volume increase is going to be related to dealer hedging flows. And we'll touch on why I think that is here over the course of this presentation. But that we keep hitting, record options volume days, right? We had so many of those in April with the craziness. S&P just narrowly touched all-time call volume a week or two ago. So these volumes just continue to grow. And again, this is why we think the impact of the options market is so important on underlying stocks.
And what are we seeing on this next slide with respect to clearing type?
Yeah, this is one of the interesting things. So you talked about, or you brought up the idea that the facilitator, the liquidity provider in the option space is much more concentrated, and what you see here is data from the CBOE. What you see here is daily volume in the option space by entity type, right? So firms are banks like a Goldman or a JP Morgan, right? But the market makers are so much of that liquidity. You can see this black line doing about 60 million contracts a day, and then they face off primarily with customers. And who is a customer? A customer is a broker, is a hedge fund or a retail trader, right? Those are considered customers, kind of the buy side, so to speak. And you can see those are the two largest segments of volume here. But that market maker is such a huge part of this options volume. And so that's why we do so much to try to model their flows to estimate the impact on stocks.
And so here next, we're going to get into this concept of delta, and you'll hear this all over the place. You'll hear people saying we're delta hedging this, or a lot of people don't understand the concept of delta, but they'll hear it a lot. So can you just at a basic level define what delta is?
Yeah. So delta is specifically the change in an option's value for a $1 change in stock. So if you have a 50 delta option, and the delta is determined by models like Black-Scholes, so it comes out of a Greek model, we call that. But if you have a 50 delta option and the stock goes up $1, then your option goes up 50 cents. But we could also look at it as a hedge ratio, right? So think about this, Jack, for a second. Let's say that you have one option, right? And it's a 50 delta option. So the stock goes up $1, you made $50, right, on your option. Very exciting. If you shorted 50 shares of stock at the same time, then your P&L wouldn't change, right? Because you made $50 on your option, but if you're short 50 shares of stock and the stock goes up $1, well, what happened? You lost $50. So you're delta neutral there, right? The price didn't impact your P&L, right? Because you had that hedge on. And so this all matters because in the 1970s is when they figured out the Black-Scholes model by and large. And what they tried to estimate, or what they figured out through that model, is that they could cancel out the price risk, right, of the way that the underlying moved and the way the options moved by hedging with stock. And so that's why delta comes out of this Black-Scholes model. It's a very simplified example of what the Black-Scholes model tells us and where delta comes out of that model. But for the purposes of this conversation, we're really going to talk about this idea that delta equals my hedge ratio. And so in this chart, what you can see is that delta is not static, means it's dynamic, and it changes as the stock goes up and down. And so with that, you can assume that the hedge ratio, or the required number of shares to hedge, goes up and down as the stock price moves. And so that means that these deltas need to be constantly adjusted, right, as the stock is going up and down.
So the idea with Black-Scholes, just for people, most people are probably familiar with it, but it's the idea, it gets at what the factors are that influence the price of an option, right?
That's exactly right. And so all this sources back to the idea of a risk-free rate of return and what is fair value for, say, buying a call option on a specific stock versus saying just putting your money in T-bills, for example. And so to kind of do that, the Black-Scholes model had to sort of isolate that price risk, right? They have to call it what is a risk-free rate of return. And it's the alternative of saying owning an option versus owning, an instrument that doesn't have risk like T-bills or something like that. And so in order to do that, they had to figure out or estimate essentially a way to isolate or remove the price risk. And so to do that, if you own an option and you're short or long a certain number of shares, then ostensibly you don't have any risk to the underlying shares of stock going up or down, right? What you essentially have is a probability is what the options are pricing out. And this is all sort of getting, I think, a little more complicated, and there's a bunch of Black-Scholes courses out there and videos out there. But what you get out of this Black-Scholes is, again, this idea of delta and how many shares of stock you need to sort of cancel out the price risk of the option that you hold.
Okay, because I was bringing it up because this idea, I think one of the ideas that's important to get here is when you make your options trade and the dealer hedges their position, that hedge is only good for right then.
That's exactly right.
A bunch of stuff is going to start changing now. The price is going to change, time's going to pass, volatility is going to change, and that's going to require the dealer to make changes to their hedge rate. And that's sort of the idea of these flows. And we'll get into what the flows are later, but I just want to set the stage with that. That's what's causing these flows, right?
That's right. And so if you look at this chart here, and this is just looking at the change in the underlying stock price. So if the stock's at 60 in this example, you can see that the delta of the option is 55. Well, as the stock goes up or the stock goes down, the delta of the option changes, right? And so if you have 55 shares of stock to hedge yourself at 60 and the stock goes all the way down to 50, well, you only need 13 shares. So that's getting exactly to your point of how many shares of stock do you need, right, as your delta hedge changes. And so how do you model how that delta is changing, right? And that gets into this idea of Ganna, Vanna, and Charm that we're going to talk about here.
Yeah. And so in this next slide, we're looking at the idea that as all of this builds up and all these trades go to the market makers, that leads to these hedging flows.
Yeah, and so the best known example of this probably ever was the GameStop gamma squeeze, right? And the idea here was that when you have all of these retail traders, or there could be hedge fund traders as well, everyone agrees at the same time to buy a small number of options, right? So in this case, everyone's buying, a 10 lot of GME GameStop calls, and the market maker, remember, there's only about six maybe large, like significant size of market makers out there that trade all the size. So most of the time, it's going to be a couple of market makers who are going to be on the other side of these positions. So if we're all buying GameStop calls, they're selling those calls. And so if this happens quick, right, because someone posts something on Twitter, like Dave Portnoy today said, I'm buying Tesla stock or whatever. So we got to buy Tesla options. Then all of a sudden the market makers are sitting there going, uh-oh, I actually just sold a ton of GameStop calls, right? I didn't have a view on GameStop, and everyone all of a sudden just came over and snuck it up on me. And there I am short all these GameStop calls. So if you model these out, let's just say that they're 50 delta calls, that's what the model tells me, then that means that I have a significant amount of stock I need to buy, right? Because if I'm short calls and the stock goes up, that's a problem. So how do I hedge myself? I buy shares of stock. And in this case, 50 delta calls at 100, when you have 100,000 calls and they're 50 delta options, that can equate to a lot of shares, as you see in this example here, right? 5 million shares. And they got to do that pretty quick. They don't have the luxury of saying, I'm going to wait 2 days to buy all this stock. It's like, I got to get in there right now and buy these shares of stock. And this is the transmission mechanism between options trading and the impact in the underlying. It's these hedging flows.
That makes sense. And I think we're going to get into more of those hedging flows as we work on. And we'll continue to use this GameStop example because obviously as things change with GameStop, those flows changed as well. So we'll work through that as we go through the presentation.
And the basic way that delta hedging works is pretty simple. And you can see that in this chart where Jack, if you buy a call, right, and I sell you that call, I'm short the call, so I have to buy stock. And so the first order implications of this are pretty simple. And as you mentioned before, the delta hedge works for right here, right now. As soon as the underlying stock moves, or as soon as time passes, right, which is time is obviously constant, then those shares of stock have to be adjusted. And we can very easily model out how these deltas or these shares have to change over time and over price. So that allows us to sort of forecast hedging flow impacts. But as a basic model here, you can see on this chart that it's pretty simple what the exposures are, right? The buying and selling of shares around the contracts that are trading.
So in this next one, we're going to add a little complication here, and we're going to get into gamma. So what is that?
Right. So gamma is the estimate for how much delta changes for a change in the stock price. And so just to get an idea of what this looks like, you can see that this delta on this chart here, it has a curve to it, right? It looks a little bit like an S. And so what gamma specifically is doing is it's telling us the rate of change in this curve, right? It's telling us how delta is changing as the underlying stock is moving. So what does this really mean? Let's just give you an example. In this case, we have a $100 stock, right? And we're looking at a call option with a 105 strike. And so all I did between these slides or different pictures was I moved the underlying stock up. So in the first image, the stock is $100. Then I went to 101, and then I went up all the way to 110. And so if gamma is telling us how much delta changes for a $1 change in stock, well, you can see here, right? The delta of this top option is 14 and the gamma is 5. Make sense? And all this comes again from Black-Scholes. Well, I moved the stock up $1. So what is my new delta? My new delta is 20. Well, what is 14 plus 5? That's basically 20, right? So you can see how gamma describes how delta will change for a $1 price move. Does that make sense?
That makes sense. Yeah.
So that is the new delta when the stock goes up $1. Now, if the stock goes up $10, you can see the delta of my original option, which is the 105 strike. I had a 14 delta when the stock was 100. Now, if the stock goes up to 110, my new delta is 88. So the difference between 44, right, and 14 describes the deltas that I have to buy because the stock is going up. So if I had 14 shares of stock in my first example, I need to move myself all the way up to 88 shares in order to hedge myself. And so you can imagine, back to the GameStop example at the start, if there's thousands of calls being bought, as that stock is going up, as a market maker, I have to start buying more and more shares of stock as that stock goes up. And that can create that kind of squeeze, gamma squeeze sort of scenario that a lot of people talk about.
Yeah, so that's basically what we saw with GameStop, right? When the price was going completely out of control. This was, I mean, obviously there's probably short covering and other stuff that played a role, but this was a huge part of what was going on.
That's exactly right. And sometimes this can be the flame, right, or the tinder that really gets stuff going, because you have to also understand, once those GameStop calls are bought, it almost doesn't matter if anyone else buys more GameStop calls, right? The risk is there, and if the stock starts to move up, you have existing exposure that you have to hedge, right? So obviously there's continuous trading in the options landscape, right? But as that stock moves up, as a market maker, I don't necessarily sometimes have a choice. I just have to start buying shares of stock because the stock is going up. So the two things are sort of reflexively, like to say, because the stock going up leads me to buy more stock. I could push the stock up if I have to buy enough of it myself, and then that can make me, the delta increase, which means I have to buy more stock. It becomes a feedback loop where the fuel just kind of increases and the flame gets brighter and brighter and hotter and hotter.
So in this next slide, we're introducing a concept you hear all the time in options, which is implied volatility. And many people are probably used to actual volatility, what I actually see in front of me. But this is a little bit of a different concept. So can you explain what implied volatility is?
And we're talking about implied volatility here because we're going to talk about Vanna in a second, and the two are intrinsically linked, Vanna and implied vol. And when you talk to a market maker or someone who trades an options portfolio, they won't talk about options in terms of the bid and ask in terms of dollar prices. They'll talk about the bid and ask in terms of implied volatility. And so what implied volatility represents, and when you hear someone quoting it or talking about it, it's the market's expectation of future movement or of future volatility. And that's in an annualized term. So if I say, hey, tomorrow's at the money implied vol is 14, 14 means 14%, and that's on an annualized volatility term. And the rule of thumb, just to break this down or make it into more of a kind of a bite-sized understanding, if you have 16% implied vol, that means the market is forecasting essentially a 1% daily move in the underlying stock. So again, if tomorrow's implied vol is 16 for tomorrow's expiration, that means the market's pricing in roughly a 1% implied move. Now, the way that we calculate implied vol is it's an output from Black-Scholes. So we won't get into exactly how this is all calculated today, but just know if you look up Black-Scholes and you put in an options price and a couple of other metrics, it will spit out an implied volatility value to you. And the reason that we like to talk about things in implied volatility terms is because it normalizes things across stocks and ETFs, right? Or normalizes things across time. So for example, if I was to tell you that last year, the at the money implied vol in the S&P was a 10, well, the S&P back then, I forget where it was, but let's say the S&P was at 5,000, right? Well, the S&P today is all the way up at 6,200. So if I was to quote you the bidder offer in dollar terms, you couldn't really equate the two, right? Because the S&P is now $1,000 higher, 1,000 points higher. But if I told you that the S&P implied vol was 14 now and it was 14 back then you have an understanding of the volatility or the prices in the options market on a relative basis. Does that make sense?
It makes a lot of sense.
And then it also helps us, like we're saying, Tesla implied vol is 80, but the, Palantir implied vol is 60, right? So you can then directly compare those as well. So that's why the implied volatility or quoting things in implied volatility terms is really quite helpful in terms of when you're looking at various options prices.
And for anyone who's interested in the rule of 16, which you just referenced there, we have a whole video on this series with Matt Cashman explaining that in detail as well.
There you go. And he does a much better job explaining it than I do, I'm sure. And again, this will be clear why we kind of did this segue to make sure everyone understands implied volatility a bit as we move forward. So implied volatility could change.
Carrying that example all the way through, like I would assume when what was going on with GameStop, implied volatility of GameStop, which we look at as the expectation of future volatility, just went insane, right?
That's exactly right. And so, it's hard. It's oftentimes hard to isolate a specific flow or specific variable because so many of these things are interwoven, right? If a stock starts to go up because there's this gamma squeeze, right, and all this attention, well, the volatility or the implied volatility in the options prices are going to expand as well, right? So that starts to invoke these other types of flows. It's a similar thing if the market's going to crash, right, and the VIX goes like 80. well, that's skewing prices as well as the fact that the stock market's crashing, right? So, a lot of these things, again, become intertwined with each other, and these different impacts become intertwined or related to each other.
Yeah. Okay. And then, yeah, the idea is when these implied volatilities go way up, what they could do with GameStop, these options get incredibly expensive, right?
That's right, and that starts to invoke the idea of Vanna as as a significant flow, and so we're going to touch on that one here next. So to give you an idea of how much implied volatility changes and why prices matter so much, these are the prices in implied volatility terms of 1 month options. So options that expire 30 days from now. So the strike is on the x-axis, and then you can see the prices of the 1 month to expiration options. So a 10% on the money right now option in the S&P here has essentially a 12 implied vol, for example. To give you an idea how much this can change, back in April when the market was crashing because of all the tariff-related events, you can see how much higher the implied volatility was, right? Because the market was crashing, it was down 10%. People were anticipating much larger moves, right? And so this is telling us that implied volatility jumped. Options on a relative basis cost a lot more, and this was a signal that Vanna as a flow was likely much more impactful to delta hedging, right, into how deltas would change. And so this can just give you an idea of how much movement you can see, right, on a relative basis during periods of crisis period versus relative calm.
And so this leads us into this idea of Vanna in the next slide.
That's exactly right. So, imagine this here. We would call this a 40 vol environment, right, where the gray line is, and then the green line is maybe like a 20 vol environment. And so, what am I getting at? Well, look at this chart here, and this actually comes from the OCC. You can see here we modeled puts and calls, and this is the delta versus implied volatility. So if we just shift these curves around, you can see how delta changes. So for example, a call, right, you'll notice that the in the money and out of the money options have relatively more similar delta in a high volatility environment versus a lower volatility environment. And the same thing for puts. So what does that mean? Well, let's look at the puts, for example. When the vol is very high, you can see that the delta impact, right, from an implied volatility change, it's almost linear, right? And if you start to drop implied volatility, you can see the delta for an in-the-money option drops really quickly, and that out-of-the-money option seems to shift up. So the point here and the takeaway here is that even if the underlying price doesn't move, and all that moves is expectations, right, implied vol going up and down, then that delta changes on its own. So think about something like a FOMC event, for example. Implied volatility is going to be high because people are unsure of what Powell is going to say, right? So let's say that implied vol going into when Powell speaks at FOMC is 20, and Powell just says, "Hey, everybody, I don't know, everything seems fine. Good meeting. See you tomorrow." And everyone's like, "Well, nothing happened." So implied volatility suddenly drops, right? Because there's no risk. As soon as that implied volatility drops, all these deltas are changing, and that invokes these hedging flows that have to kick in. And then you start to get a reaction out of the FOMC. Does that make sense?
Yeah, it makes a lot of sense. So like with GameStop, eventually the implied volatility got completely out of control and it had to come down.
That's
And
exactly
when it
right.
came down, that generated a bunch of flows, basically.
That's exactly right. And we just saw this recently with Circle, which IPO'd and went up, I think, 12 times right after the IPO. But GameStop, the implied vol got into the 400 or 500%, right? And if you look at where GameStop implied vol now is, it's at like a 50, I believe. So what happens is at some point, the implied volatility gets so expensive, right? And remember, implied volatility, you can divide it by 16 to calculate what the estimated daily move is. So implied volatility can get so high that traders are pricing in, 50% daily moves in the stock, which is just not sustainable, right? So you hit these events where the implied volatility gets so rich and so high and so elevated that it almost starts to suffocate the move that's happening, right? Because how many days in a row could GameStop move at 50% a day, right? It's not going to do that every day for the rest of the year. It might have 1 or 2 more days like that, but that implied vol just gets again so expanded and so rich, right? That it basically is just telling you like, okay, the options are pricing in unlimited movement, right, for the next year, which is just not going to happen. And so oftentimes you'll see stock moves stall out when you get those levels of options prices.
And this is a little bit of an aside, but it's an interesting thing about how options are priced. Like, I believe a lot of people who bought puts at the peak of GameStop's implied volatility actually lost money, even though the stock tanked because of this effect.
Yeah, that's exactly right. And you could actually buy. So let's say that or you could sell rather like a 50 strike GameStop put, right? So your max risk in that case, or the max if you sold that put, the max you lose is $50, right? You could sell that option for something like $48.
Oh, wow.
So, you basically had no risk because was GameStop going to go from being a $400 stock or whatever it was at a 400 implied vol to zero in a month? Probably not, right? Crazier things happen, but when the market's forecasting 25% daily moves, those are the type of aberrations that take place. And you see that oftentimes with a lot of these different names where and what happens is the options prices can be, again, reflexive. And what I mean by that is when demand kicks up, right? Because everybody is buying GameStop calls and the market maker exposure is getting very rich and very high. Well, what's the number one way, Jack, that you would dissuade someone from buying something from you?
Make it expensive.
You make it expensive, right? We talk about this all the time. Like, I don't want to sell you my house, Jack. I like my house. I don't feel like moving. But there's a number. If you came over and wrote me the check, I'd be out of here in 20 minutes, right? You just got to give me the right number. And it's the same thing with options, right? If I go, hey, I'm selling too many of these calls, right? I don't want any more of the exposure. People keep buying me these options. Well, then I'm just going to offer them for such a ridiculous price that I'm actually happy to sell them, or I'm going to influence you to sell because they're so highly priced. So when implied vol, like in that GameStop situation, hit 400, the really smart options traders are like, okay, if I was owning calls, I'm going to sell them because I made a ton of money, or maybe I should start shorting these things because the prices have gotten so crazy, right? So, if you want to come over and offer me $5 to $10 million for my house, Jack, it's standing offer. For anyone else that matter, you can email me and I'll set it up. But that's all it takes, right? Is the right price to start to incentivize people to take various actions.
So in this next slide, we're getting into numbers, an example of this with some numbers attached to it.
Yeah. So this, just like in the Gamma situation where all I did was move the underlying stock price, all I did in this example was I didn't change the stock price. All I did was change the implied volatility. And so if you just go to a Black-Scholes calculator, you can try this yourself. But the first example is stocks at 100 with the 105 call. This is 1 month expiration. The first example is a 10% implied vol, right? The delta of that option is a 5. Okay, so that's 5 shares of stock. Next one, I move implied vol to 20. So I doubled implied vol, went from 10 to 20, and the delta went from 5 to 21. So in that situation, if I'm just sitting here and someone goes, guess what? Tomorrow Apple is going to announce a surprise product. You go, I don't know what that product is, right? But suddenly traders have to price in more movement, right? Because they're going to announce this product. So what does that mean? That means the implied volatility or the movement that traders are expecting is moving up. So that means all of a sudden the delta goes up. So I have to buy 15 shares of stock just because that implied vol went up. Does that make sense?
It makes sense. Yep.
And then if vol goes really crazy because Apple announces a new AI product, and as soon as you hear AI these days, like, oh man, I got AI. All right. Well, then my delta went to 40. So in that situation, if I'm a dealer, I'm short calls, and all that happened is implied vol went up, I suddenly have to buy 35 shares of stock just because that implied vol jumped a bunch. And so again, underlying stock price didn't move, but imagine then the next, take this to the second derivative of this whole thing. Well, you move implied vol up and Brent has to start buying stock. Well, then that invokes a little bit of gamma, right? Because remember in the earlier example, if the stock price goes up, then gamma is dictating that my delta is going to go up as well. So these things, again, become reflexive. They become feedback loops, kind of like a Venn diagram of overlap here, where you can see how these various flows can infect or transmit change in the underlying stock price.
But just to make sure I'm getting all this, we had gamma, which is the change in delta for the change in price. We had Vanna, which is the change in delta for the change in implied volatility. And now we're going to have charm, which I believe is going to relate to time.
That's exactly right. Now, you will hear a lot of people sort of conflate, and this is credit to, I think our friend Jam Croissant, who really brought the idea of Vanna and charm to sort of the mainstream. And generally what people do is they'll talk about Vanna only in the context of volatility going down, right? Which we just showed is not true. Vanna matters both ways. If vol is going up and down, it changes delta. But people a lot of times say Vanna and charm like they're linked together or they're the same concept, and they're not. They're distinct. So what charm specifically is the change in your delta as time is passing. And so in this case, this is a call again from the OCC. You can see at 1 month, the out of the money options have the delta moves to 0 or to 1, right? Here's 1 delta at the top and 0 delta at the bottom. So I need 100 shares for an in the money call, and I need 0 shares to hedge an out of the money call. And that makes sense, right? Because if I own an 80 strike call and the stock's at 60 and it expires in 20 minutes, guess what? That 80 strike call is not worth anything, right? So it has no delta. And so the more time you have, the more the delta on those wings moves to kind of 50. Does that make sense? You can see that.
Yeah, it makes sense. So the general idea here is if I own an option and I have the right to exercise that option for 30 days, or if it's like 3 hours till it expires, that option has obviously a very, very different value.
That's right. And it's the likelihood of something being in the money, right? Because if the stock is currently at 60 and the option expires in 1 month, the odds that the stock goes from 60 to 80 in the next month, pretty low, right? But what is the odd that the stock goes to 80 over the next 6 months? It's a lot better. You got a lot more time, right? So that time value there matters to the delta. And obviously you're talking about time decay and theta is sort of a related concept as well. So what does this mean though for us? Particularly when you get into expiration, it can impact the deltas quite a bit. And so in this example, again, I held the stock price constant and I held the volatility constant. In this case, volatility is just 20. It's the same strike 105 call. At the top here is, well, let's start at the bottom actually. At the bottom here, this option has 1/4 of a year to expiration, right? So that's about somewhere between 60 days, right, to expiration. And it has a 36 delta to it, right? I didn't do anything. I just changed the time from basically 2 to 3 months to expiration to 1 month to expiration. That's what 0.08 years means. And the delta went from 36 to 21, right? And then what happens if I just have about 1 week to expiration? The delta all of a sudden of this call is just a 0.07, right? So it's less than 1. So what happened here? Well, the call that had all this hope, right, 3 months ago, when I'm a day from expiration, the odds that the stock goes from 100 to 105 is a lot lower than it was obviously a couple months ago. And so there's no delta left in that. So why does this matter? Well, it matters because imagine that I'm a market maker, right? And I'm short this call and I have 36 shares of stock as my hedge. Well, if nothing else happens, the stock doesn't move at all, right? It just stays constant. This entire time that I have this 36 shares of stock, I'm just selling it out over time, right? Because why? I needed 36 shares here. Then a month later, I only need 21 shares. And then, a couple weeks later, I only need 1 share. So I'm just constantly, selling, right, these shares of stock against the position that I have. So you can imagine if this is hundreds of thousands of positions or millions of contracts like it is in the S&P, that these charm flows, right, can be significant in terms of kind of like this passive movement. And then as we get closer to expiration, and that decay really starts to increase, that charm can become even more impactful.
Yeah, when we roll this up, we've got significant flows now impacting the market. So we've got prices are changing, implied volatility is changing, time is passing. Each one of those individually is generating a series of flows. All those flows are coming together and they're impacting the market in different ways at different times. Right. So a lot of us that are long-term investors, we're seeing these market movements. And a lot of times they're caused by this, even though we might think they're caused by something else.
Yeah, and that's exactly right. And so when I think about this and I want to sort of break it down, a lot of these flows are sort of linked together as we just covered. But let's talk about this situation right in April, where we had the VIX spike to 50, 60, one of the highest VIX spikes ever. What does that mean when the VIX spikes? It means that the SPX options prices are extremely high, right? The VIX is just a calculation of options prices in the S&P 500. That's all it is. So when the VIX is spiking like that, that's telling you that the options prices for the SPX, the biggest index in the world, are getting extremely elevated. So if we know that, right, if we know the implied volatility, i.e. the options prices in the S&P are expensive, what flow is probably really important then from an options perspective?
Vanna.
Exactly. So when you have this situation then where you could see the S&P in blue here was tanking, right? And the VIX was at these incredible highs, right? Then we know that this Vanna is extremely important. Charm is not as important there because in mid-April, right, the expiration wasn't necessarily there. And then obviously you're getting a ton of underlying stock price movement, so there's a lot of this gamma moving around as well, right? But this is the significant flow. If VIX is at 50, right, Vanna is this huge thing you have to think about. So let's talk about then why we get such a violent move down, and then the rebound is even just as sharp or just as heavy, right? So let's talk about, in this case, the crash recovery. And when you sort of go through the crash recovery, you can understand that it was the same flows that brought us a lot of the downside pressure when the VIX spikes, right? So the VIX spikes in this case, as we just showed, up here around 40 or 50. So what happens to help drive the market bounce, right? Because as value investors or people with long-term views, there's not many of these giant spikes, right? So it doesn't matter what type of investor you are. When the VIX hits 50, we're probably all watching the market, and maybe you're thinking, hey, is there some value that's unlocked here? Is this a good bottom opportunity? So let's say that we're looking at a 5500 SPX. That's where spot is, right? And let's say that we're looking at a 5250 put, and this has a little over, about a month to expiration here, right? At a 40 vol, the delta of that option is 14. So what does that mean? It means if I was short that put, because Jackie bought that put for me, I'm short the put. I have to be short, let's just say 14 shares of stock to simplify this, right? Great. So 14 shares of stock. Now what happens is if we move time just a little bit forward, the VIX doesn't come down. Just the fact that we moved time forward means that the delta went from 14 to 9. So that means just because we advanced time just a week or so, I got to buy 5 shares back, right? And so again, this is only one example, but if we had millions of contracts, you could see that charm effect kind of kick in, right? Now what happens if time moves forward a little bit and vol comes down? Well, the delta of that option is now only a 4. A 4. Combined 4 and 3 or 5, not a good idea. 4. So all that happened was we moved time forward a little bit. We brought vol down 10 vol points from 40 to 30, and the delta of that option went from 14 to 3 or 4. So that means 10 shares of stock I bought back. And this is an out-of-the-money option with not much time to expiration. So what does this mean? That means that I start buying these options, my underlying hedges back, right? These options are losing value because the volatility is coming down, because time is moving forward. So there's this charm and Vanna effect. They're sort of combined with each other. And that means that there's these buying flows that come from the Delta community, right? Because everyone bought puts to crash protect themselves. As a market maker, I'm short those puts. That vol comes down, that time passes means I'm buying stock back, which does what? It pushes the stock market up. And when the stock market starts to move up, then you start to invoke some of that gamma, right? And that gamma means that as the stock market goes up, I have more and more shares of stock I have to buy back, right? So that creates these feedback loops around these events that can be, in my view, an extreme driver of underlying price action.
And this is, I assume, when you can see the big impact from options flows, when all of these flows align in the same direction.
That's exactly right. And that's why anytime you see the VIX like at 50, right? Or you see a stock that's just going all over the place and you look at implied volatility of that stock and you see it's at something crazy like 200, you know that the options market is having a massive impact on the way that that underlying stock is moving. And I think we've talked about this in some of the OPEX effect videos. You can often see when the options prices hit extremes, like we saw like within gold or Chinese stocks recently, that means that the move's kind of coming to a crescendo. It's sort of about to expire. Because you see it in these options prices, and these options flows are going to be again such a driver of price.
Before we get into expiration, I just want to ask you one other thing about gamma, because you'll see a lot of things on the internet where you can see these charts of like what gamma exposure is right now. Can you just talk about what that means in terms of like what these dealers will do and how it affects like the volatility of the market?
Yeah, if you think about gamma, it's how are we going to adjust our hedge as a market maker, right? And so the idea is that if you get gamma concentrating at a specific strike, and we do this at SpotGamma a lot, we monitor where the strikes which hold the most options positions. When you look at a big strike, right? Let's just say it's $100. If the stock moves over a certain level, and we model that market makers have to sell stock, right, when the stock moves above that level, if they're big enough, because their gamma hedge dictates that they have to sell incremental stock as the stock goes up, that should push the stock back down. And the same thing, right? If the stock market's selling off and we model that the gamma hedge says that market makers will buy into a weaker market, if they're buying enough stock, it can push the stock back up. So knowing where market makers own options, right, and whether they're short or long, and then allows us to sort of estimate these flows, right? Because now we can see, hey, we know that market makers are short or long at this specific strike, and this is the action that they have to take. And so if you have a situation where there's millions or billions of dollars of gamma hedging flow at a specific strike or in a certain area or range of a stock, then we believe that we can really see, and there's some statistics that prove this or support this, we can really see that these hedging flows can dictate the price action of both underlying stocks as well as the index itself, like the S&P 500.
So when I see like there's a lot of positive gamma exposure, that means they're going to be going against to some degree. They're going to be reducing volatility. And when I see tons of negative gamma exposure, that means they might be exacerbating volatility. Is that right?
That's exactly right. So if you have what's called positive gamma in your portfolio, it means that you own an option, right? So what does that mean? Let's say that as a market maker, I own a call. If the market goes up or if the stock goes up, that's great. My call is going to make money, right? But how do I hedge that out as a market maker? Well, if my call is making money, right, because the stock is going up, I need to keep selling shares of stock as the stock goes up to hedge out that option position, right? Because I'm making money on the call itself because the stock's going up. And so if I sell shares of stock, then again it comes back to this isolating the price move, right? Then if I sell shares of stock, I'm locking in those gains essentially, right? Or I'm delta hedging that position. And so you can imagine again, if I'm a market maker and I'm long tons of calls, right, the more the stock goes up, the more shares of stock I'm selling, and that can start to slow down the price move of the index or the stock I'm trading. So if you think about it, right, what is one of the most popular forms of options trading in the S&P 500? If you think about the JP Morgan collar trade that we talk about a lot, if you look at JEPI, the JEPI or the QYLD call overriding ETFs, there's 30, 40, 50, $100 billion across all three of those, literally $100 billion across all three of those in systematic call overriding, right? So what is call overriding? JP Morgan sells a call to bring in money, right? To bring in yield, right? That means market makers or options dealers are buying those calls. They're long those calls. So if you're long those calls and the market's going up, you're selling shares of stock to hedge that out, right? And it can become this flow that really starts to slow the market down into a grind.
So as we head to this next slide, this is a very important part of this because there's a cycle that goes on every month, or there's more than this, but every month we have a significant options expiration, and the flows that could be a big changer, right, of the flows that are going on. So this cycle is really important in understanding this.
That's exactly right. And this is why we do the OPEX effect every month. And the idea is that on the third Friday of every month is generally a very large options expiration. The biggest expirations are the quarterlies, which is the March, June, September, December expirations. But every month there's a pretty good size one on the third Friday. And you'll see options positions will build up into that third Friday expiration. And as those options positions build, right, it makes that third Friday more important to the way that stocks trade, right? And that's because the hedges start to increase or concentrate, right, into expiration. This is where gamma comes in and that charm effect comes in because there's a lot of time decay. And then when those options expire and go away, then the hedges related to those positions also go away. So before you mentioned a stock kind of pinning to an area where there's a lot of gamma at a certain strike, right? Well, if all of that gamma and all that hedging flow is tied to the 100 strike, but then all the options at 100 expire, well, then why should those hedging flows pin us to 100 anymore, right? The answer is, well, we would argue they shouldn't. And so you may see the stock oftentimes move away or trade away. It can also be a reason that we'll see a lot of price points or price price trends, change into expiration. Because you can imagine that if Jack, you own a whole bunch of puts, right, and the market's tanking, and I'm selling stock to try to keep up with the puts that you own, right? I'm short puts, I'm selling stock, selling stock. All of a sudden, the puts expire. Well, then I'm sitting there with no more options position. You're happy, you went away with your hedge, you sold your hedge, you're done. But I short couple 100,000 shares of stock. I don't need to be short stock anymore. So what do I do? As soon as options expire, I buy that back, right? I buy all that stock back, and then that creates oftentimes a bottom in the market.
And that's why you can see, and nothing's predictable in the market, but you can see somewhat predictable flows, right, as we get around these expirations, if you understand how everybody's positioned in terms of how these flows might work.
That's exactly right. And not every expiration is the most important thing in every stock, right? But you get these massive turning points oftentimes, and typically they come when there's a quarterly expiration, which has significant options positioning, and then you get a big price move. So this red X shows you each monthly expiration in time. And again, not every single options expiration matters, but you can see there's plenty of them that mark literal turning points. And if we just look at the recent market flows, the previous all-time high, we just broke it, but was February, right? And February marked to the day the market dropped from that all-time high, and it sold off very sharply. Same thing, just in this recent June expiration, we see this giant June expiration, which was the largest options expiration ever. And then as soon as all those positions expire, bam, market breaks all-time highs. You're up 3% in the course of 1 or 2 weeks, and there's just this massive move, right? So these options expirations are oftentimes turning points, particularly for an individual stock. You'll see movement, but it can really dictate again the behavior of the S&P 500, both in terms of price direction and oftentimes volatility.
Yeah, and I think COVID, which you brought up, is a really good example of this because if you think about it, for someone like me who doesn't know a lot about this, basically we had all this bad news coming out around COVID. We had China, we had Italy, it was breaking out everywhere. And people like me were sitting there saying, market's not going down. Why is the market not going down? We have an options expiration. Market goes down. We have a massive move down. Again, at the other side of it, the absolute bottom on a expiration. So it's not as if that was the reason all of this happened, but to me, it tends to be, it affects when and it affects the magnitude of it to me when I think about these things. So maybe the fact that we didn't go down for a while related to COVID was something to do with flows in the options market. And then once that expiration cleared, it allowed the market to go down. And maybe the same thing happened at the bottom. So I don't know if I have that right, but that's kind of as someone outside of this, the way I look at it.
I think that's totally true. And as the options market grows and as the use of derivative increases, I think that that it has more of an impact on the market. So if you think about the DeepSeek fiasco, right, that we had in January, right, with Nvidia, and Nvidia had the largest market cap drop ever. Huge options position. Nvidia is the largest options single stock options entity in existence, followed by Tesla. Tesla just had, you think about Elon just had that fight with Trump a couple weeks ago. Largest drop, I think, in Tesla in years, right? It was down like 14-50% in a single day, right? And so what happens now is people used to say, well, the reaction to the news is more important than the news itself. And what happens now is you get such extreme reactions, I argue, driven by these derivative flows that people go, oh my gosh, DeepSeek must be the most important thing that's ever happened because NVIDIA just tanked, when it was actually this leverage from derivatives, right? And these hedging flows that is exacerbating the price movement. So that often we think unlocks opportunity, right? Because we think the market overreacts to things now because of the options. But I think you'll just start to see more and more crazy movement. Think about it this way, right? We saw the VIX spike to, the 50 area, and this was the largest VIX spike since I think the COVID crash, right, that we just had in April. Well, you and I covered extensively when the VIX hit 60 just in August of last year, right? So you start to see like these unbelievable moves in the volatility landscape and weird jumps in prices as the use of derivatives increases. And I think that's a trend that we're only going to keep seeing. And again, it highlights the importance of monitoring these options flows when you're trading the underlying.
It's a really important point because I do that as well. Like I tend to look at the movement in stock price in relation to something and say, that tells me how important that thing is. Well, if these flows are exacerbating those moves, then maybe in some cases the news wasn't as important as we thought it was. Just options took us past, that point. And maybe there's some sort of opportunity, obviously not for people like me, but for people like me, it's good to understand that and to say, all right, maybe I have to not just think about how important DeepSeek is, but also think about maybe DeepSeek's not as important as the market is telling me because of these flows.
Yeah, well, I would argue, Jack, I know you have a longer term view in trading and investing, but you have a book of names that you like, and okay, they're probably not all, Tesla and Nvidia, but this happens in smaller stocks too, where you'll see a name be down 20%. And, you're like, hey, I like this stock, but I don't understand why it's down 20%. And then you go and you look and you go, well, there's huge options volume, and 75% of that options volume was tied to this Friday's expiration, right? So then you get this extra extra source of information saying, look, this is just short dated options flows that is really driving this price. It's not that hedge funds are buying 6-month out options because they know something's going on. There's so much of this short dated momentum trading, right, in the options flows that drives these market making activities, that can dislocate price. And if you're a value investor, you're looking for a name on the cheap and you go, hey, this is dislocated because the option space, this is a favorable buy for me. I've been waiting to buy NVIDIA down 20%, for forever. And I know it's the options market, or I believe it's the options market that created this price dislocation. Then maybe there's great opportunity in that, right? And maybe that only shows up a couple times a year in a couple of different names. But again, if you know it's the options market driving, or you believe it's that options market driving that dislocation, then I think that can unlock, a lot of opportunity for investors of all kinds.
Well, that's right. Yeah. For fundamental investors, definitely, if you have a feeling for what the value of something is and one of these moves takes it far from that's an opportunity to maybe add to your long-term position.
Yeah, that's exactly right. That's how I see it. Which is all the more reason to come over to SpotGamma, wink, wink, and watch options flows.
Yeah, absolutely. And we should recommend that, head over. Brent is very kind to give us all the research he does here on excess returns. So definitely head over to SpotGamma and check out what he's doing. Definitely check out Brent and I as well. Once a month, you'll see us telling terrible jokes and looking at the options market on the OPEX effects. So we'll have one coming out soon. So take a look at that as well. And thank you everybody for joining us, and we'll see you next time.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on YouTube or your favorite podcast platform, or leave a review or a comment. We appreciate it.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the participants or their clients.